Interestingly, you see that M2's growth has moved from negative into positive territory, but is still very low by historical standards. Message is inflation is probably going to drop. Let's see, the CPI is on the left-hand scale here, into the 1 to 2% range, and we would not be surprised to see it go negative, as we did in 2020. And we saw in 2014 and 15, and even before that in 08, 09. So we think that will happen again, and that the Fed is going to be easing aggressively before all is said and done.
U.S. job growth in August was again weaker than expected, increasing fears that the world's largest economy might yet suffer the consequences of the Fed's higher interest rates. According to the Labor Department, U.S. employers added 142,000 jobs in August, almost 20,000 jobs less than analysts had forecast, and in line with July's lower than expected numbers. However, unlike in the July jobs report, the unemployment rate did not increase, but dropped from 4.3% to 4.2%. While some analysts believe the Fed might be able to pull a soft landing with these numbers, the consensus is that this is a make-or-break moment for the U.S. economy, and the Fed's actions at the September meeting could determine if the stock market will be plunged into a bloodbath, or if the markets and the overall U.S. economy will be able to scale through the fastest pace of rate hike in history without any serious damage. In the latest episode of her monthly In the Know podcast, ARK Invest founder, CEO Cathie gives a detailed breakdown of the economic situation in the United States, reiterating previous claims that the U.S. economy is already in a rolling recession and heading toward more uncertain times if the Fed does not begin cutting rates aggressively, starting with at least a 0.25% rate cut announcement during the next FOMC meeting. According to Cathie, all economic indicators are pointing toward a repeat of previous crises like the dot-com bubble and the 2008 Great Financial Crisis. But the Fed can still prevent a widespread meltdown if it starts cutting rates immediately. During her detailed analysis, Cathie also talks about the role of disruptive technology platforms, like artificial intelligence and robotics, predicting that the explosive growth of these innovations will not only help us avoid a complete global meltdown, but also get us back on the growth track, potentially adding trillions of dollars to the global GDP within the next 6 years. As we bring you clips from Cathie Wood's video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thank you, and enjoy the video.
We're in election campaign season, and so there is definitely gridlock, nothing happening in Washington, except, as you see here, the federal deficit as a percent of nominal GDP is still over 5%. And this is very high if you believe that we're not in a recession. If we're in a recession, then it's more understandable. There's a lot of contra-cyclical spending during, like, food stamps and social safety net spending during a recession. But one thing we know in this campaign election season is the candidates are focused on getting this deficit down. And it's been very interesting to listen to the different ways. Some would say spending cuts. Some would say tax increases. And of course, we think the answer should be a combination of spending cuts and economic growth. The best way to get a deficit to GDP down is to grow out of it. And we think that after we get through whatever this rolling recession, however it finishes, and we think we're getting close to the end of at least recognizing that it's a recession and that we've been through a rolling recession for the past 2+ years. we think that growth will take over. And as you know, we're talking all the time about the massive growth possibilities associated with the new technologies that are evolving and are ready for prime time now. I think it's very interesting that Elon Musk has been has actually put up his hand and said, "Hey, I'll help with government efficiency." You'll notice what he did at X. He cut 75% of the labor force at X, and X has not skipped a beat. Now, its advertising hasn't picked up, but in terms of the actual performance, the technology performance of X, it's gotten only better. It's getting more TikTok-like in terms of its ability to use AI and surface the interests of different people. So if he can do that at Twitter, I don't think he'll be able to do that in the government, but I know that he will bring technology to bear on the government, and that we'll probably see anyone leaving a government job not replaced. And I think the attrition could pick up if there are more interesting jobs, or more, I should say, more productive jobs created in the private sector. And what I mean by that, in the government, there is still a lot of, pushing of paper. There's a lot of bureaucracy, and technology and agentic AI could certainly help be the solution there. So I think that's an interesting dynamic that could do wonders to solve the bloat that we're seeing in the government sector right now.
According to reports, U.S. consumer prices rose only slightly in August, but higher costs for housing and other services has economists worried that there might be some stickiness in underlying inflation, dashing hopes of anything higher than a 0.25 percentage rate cut from the Federal Reserve next week. While speaking with reporters, Nationwide senior economist Ben Ayers said, "The road to normal inflation hit a bump in August, as lingering pressures for housing and service costs once again cropped up. This should clinch a smaller, 25 basis points rate cut from the Fed next week, as Fed officials remain wary to feed any lingering price momentum for the economy." The Labor Department's inflation report shows that the Consumer Price Index rose by 0.2% in August, in line with economists' expectations and in July's inflation figures. According to the report, food prices climbed by 0.1%, less than the 0.2% increase recorded in July and June. The CPI climbed by 2.5%, the smallest year-on-year increase in over 3 years, and 0.4% smaller than July's CPI increase. Cathie explains that some of these figures signal some reprieve for the economy, which will be further strengthened when the Fed starts cutting next week. The popular fund manager is in fact certain that inflation will not be a problem for much longer, which means the Fed will be able to embark on another aggressive quantitative easing campaign that will send prices skywards. Here are more clips from the video.
And you can see the yield curve had been flattening and then inverted, and has been doing so really since 08-09 in a trend sense. But you see what happens after an inversion and a move back above zero, so that short rates are below long rates. What does that typically portend? It usually means we're in a recession. You can see the shaded lines are a recession. You can see we had gone inverted. It doesn't show here. You can barely see. We inverted for a few months in 2019, and we didn't know about COVID, and we'll never know if the inversion was an indicator that a recession was going to take place. But we did end up in a recession. Here in 08-09, moved positive, we were moving into a recession. Here we were in the recession in the tech and telecom bust. We were in the recession during the S&L crisis. We were in the recession as Volcker was trying to starve the economy of money to squelch inflation. So we're probably in a recession, and we probably, by some metrics, we have been in a recession for some time. Rolling recession, I know I've been saying for a long time, housing went down immediately and is actually in a depression. But we do think that's a rubber band stretching, and that's why we don't think that this recession is going to be that bad. It could actually end quite quickly if we get those interest rates down and get the cyclical sectors of the economy cranking again, with so many people waiting on the sidelines, especially for housing, new and existing homes. On this next page, I'm flipping into what I described earlier. This is non-farm versus household employment. Households in the green, non-farms in the purple. You can see that non-farm employment growth is still around 2% on a year-over-year basis, which, if you look through history, is kind of normal. But if you look at the household employment numbers, that growth rate on a year-over-year basis is down to 0. That is more consistent with a recession, and those numbers at turning points. The household numbers are much more reliable than the non-farm payroll, because they just don't get revised like the non-farm payroll does. Here is that revision, and so you can see the revision. This is a once a year revision in the employment rate. And you can see how big this revision was. It was over 800,000 jobs that last year, when everybody was heralding the non-farm payroll employment numbers as strong, 250-ish per month. The actual number was in the low 100s when you get through with these revisions. So again, don't trust non-farm payroll as much as the household numbers. And then here, job openings, you can see those are coming down now quite significantly. While companies are not laying off people in great numbers right now, they are not hiring. They are not hiring according to this chart. The job openings are basically disappearing. Here is the chart on personal savings. You can see what has happened in here. The personal saving rate has gone down, and it's getting close to the record lows that we saw from 2005 to 2007.
Though official inflation figures are falling, Americans are still feeling the pinch of higher prices. According to Cathie, the inflation problem is going away, and the real economic challenge will actually be deflation, as technology will completely revolutionize the way we produce goods and production costs. For Cathie, this means lower prices, and an explosion in the valuation of these technologies, from currently less than $20 trillion to over $220 trillion by 2030. Please share your thoughts on Cathie's analysis for the US economy in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks for watching.